I think he's confirmed what I believe the market knew and where it was priced in. I'm looking here. I don't see any change at all in the 2-year, and I'm looking here right now at the Fed probabilities, and it's still at 265, which, by the way, is something that happened earlier today. I think more so on Mary Daly's comments, who kind of said, hey, we may be thinking about a 75 basis point hike down the road. That's the new question for the market, is just how aggressive the Fed will be. And it's interesting, Kelly, I don't know if you guys have that chart loaded for this conversation of the Fed funds outlook, but trading at 265 now is trading above where the Fed, and several Fed officials have said, is where they think the upper end of where they think the funds rate ought to be by the end of this year. They've said 2.25, 250. So the market now taking the Fed a step further and saying, okay, you guys are going to be hawkish. Well, let's price in a little more hawkishness out there. And let me just take a look here, because we now see 340 by September 2023 is where that rate is pegged right now, Kelly. So the market had been aggressively postured, and Powell really just confirming where it had been and not really going as far as some other Fed officials have gone in the recent days.
David Katz, what do you think it all means for the market?
Well, we think the Fed is trying to talk up expectations for these significant rate hikes. And the more they do and the more the bond market reacts, quite possibly 6 and 12 months down the road, the less the Fed is going to do. So we're very comfortable with the way Powell and the Fed is navigating this. We think there's a pretty good likelihood that we're going to continue to have growth next year. For sure, the economy is solid over the next 9 to 12 months, and we're hopeful that we don't get into a recession. So we think it's a delicate tightrope to be involved with, but we think the Fed is quite possibly going to pull it off. And we do think you're going to get some inflation relief by the late summer, early fall, and that's going to take some pressure off of the Fed.
And Steve, just to reiterate what you said, which is that they might ultimately bring the Fed funds rate, which is probably around 0.5% right now, to 3.4% by the third quarter of next year.
Come on, Kelly, it's 0.375. Don't get there earlier than we have to. Yeah, it's half a point for all intents and purposes. Look, Powell's talking about this concept, which David said much more simply, which is this idea of talking it up. Powell talks about it front loading, and what they're doing is they're bringing forward as much as they can in terms of restraint to the economy through talking. And I think the idea that David expressed, which is an interesting one, and it's one that people have to figure out in terms of if they're trading this short term, is does the Fed need to get all the way there if it provides enough restraint right now by front-end loading? Look at where the 2-year is. We are existing right now in an economic environment where the 2-year is really at 270. That's not a future rate. That's where it is right now. So all that restraint, I don't know what you want to call it, 150 basis points of restraint has been brought into the economy right now. And if it does indeed, if David's right and some other forecasters as well, that towards the summer we start to get some relief, Fed will probably go to 2.25, 250, but may not next year, Kelly, have to go up well into that 3% range. And that's really the thing to watch here. The debate right now at the Fed is not this year. Everybody's at 2.5. The debate right now is about next year.
So, David Katz, final word to you then on the tougher question of what do fixed income investors do? What would your advice be?
You absolutely want to stay short, but you really can buy 9 to 18-month bonds now and lock in a adequate return, and it's a lot higher than you're getting in money markets. So we wouldn't buy intermediate term bonds, we wouldn't buy long-term bonds, but the 6 to 18 months, we think you're going to get a decent return with very little to no risk.
All right, amazing to look. We had the 5 and the 7-year above 3% earlier today. The 10-year 293 as we watch the stock market selling off a little bit as Powell reiterates that half-point hike on the table next month. Steve, we'll leave it there for now, and David as well. Our thanks to you, Steve Leisman and David Katz.